I'm going to go on the no, I don't think it is triple digits. I think we could get close into the 80s. I think it'll take till 2027 before we get through $100 on silver. If you're looking at your next target for the first half of 2026, all we need to do is put a parallel trend line in from this one right here. We drag it to our previous all-time high from October, and we bring that down, and you're looking at basically a target of $5,000. And I think that'll be hit in the first half, maybe even in the first quarter of 2026. But gold looks great here as long as it does not break back below 4,300. This is a bullish chart and should continue to see upside.
Gareth Soloway views silver as standing at a critical crossroads after delivering an extraordinary upside move that has captured global attention. Since the April 2025 lows, silver has climbed more than 150%, a pace of advance that is rarely seen outside of late-cycle or emotionally driven phases. This surge has carried price directly into a long-term technical ceiling that stretches from the 1982 bear market bottom through the 2011 historic peak, a zone concentrated around the low $70s. From a pure market structure perspective, such steep, near-vertical advances tend to exhaust buying power in the short run. Even within powerful bull markets, prices typically need time to digest gains, reset momentum indicators, and allow stronger hands to replace short-term traders before the next sustainable move higher can begin. Despite the risk of short-term exhaustion, the fundamental backdrop supporting silver remains unusually strong. Demand is no longer limited to jewelry or investment interest, but is being driven by long-term structural trends such as electrification, artificial intelligence infrastructure, renewable energy expansion, and increased military and defense spending. At the same time, physical supply remains tight, with limited new mine production and shrinking above-ground inventories. Soloway highlights, however, that silver's greatest strength can also be its greatest weakness: volatility. When speculative enthusiasm intensifies, silver has a history of entering crowded trades where momentum overtakes discipline. In these moments, corrections tend to be swift and unforgiving. A decline of roughly 15 to 25% would fit well within historical norms and could easily pull prices back into the mid-$50s or low $60s without altering the broader bullish structure. Looking ahead into early 2026, Soloway's expectation is centered on consolidation rather than collapse. He anticipates a period where silver cools off, trades sideways, and rebuilds a healthier technical base after such a dramatic run. This phase would allow excess speculation to unwind while long-term demand continues to strengthen beneath the surface. If that stabilization process unfolds as expected, silver would be positioned to resume its advance with improved market structure, potentially reclaiming the mid-60s and pushing higher over time. In his assessment, a controlled pullback and consolidation phase would ultimately reinforce the long-term bull case, favoring sustained and resilient gains rather than a fragile rally driven solely by short-term momentum. Now, we present the clips from Gareth's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
If we look at the chart here, gold has broken out from its previous high of just in October, right? So here's our previous high on gold. We've now, you can see this classic upsloping trend line to the upside. Not sure where it went right there, but nonetheless, beautiful move to the upside. And then ultimately, we've now broken out above it. So gold, honestly, it looks like 2026 is going to be another solid year for gold. I'm a little bit more nervous about silver. We'll talk about that just because of the massive gains that we've seen. But I do think gold now, if you're looking at your next target for the first half of 2026, all we need to do is put a parallel trend line in from this one right here. We drag it to our previous all-time high from October, and we bring that down, and you're looking at basically a target of $5,000. And I think that'll be hit in the first half, maybe even in the first quarter of 2026. But gold looks great here as long as it does not break back below 4,300. This is a bullish chart and should continue to see upside.
So your key support level then is 4,300?
Yeah, and you can see it right here. So you've had this trend line. You can see how the price came down multiple times and is just bouncing off of it and is now broken here above the all-time high from over in October. So as long as we hold that trend line and don't start trading below, then this chart really tells you that probability favors a move to that $5,000 level, which again is right at the high end of the parallel channel.
So $5,000 gold by Q1 of 2026?
That would be the aggressive target. I'd like to give myself the first half to get there, but nonetheless, I think it could be based on the momentum. I mean, we're going up $100, $200 sometimes in a day on these bigger days. So it could be easily in the first quarter of 2026.
I mean, we have Jim Ricketts saying that we could even see $10,000 gold in 2026.
Yep. Yeah, listen, I mean, that's an amazing list. I hold long-term holdings in gold. I would be
I know.
thrilled with that. I love that thought process. But again, I'm just more of a technical trader, so I have to have the charts telling me that. And we would have to get through this $5,000 trend line for me to go with that. Just like with Bitcoin, you could see that trend line from 2017 to 2021. It capped the upside at about 127,000. So I have to go with the charts on this, but I love his thought process. So if we go back to the chart, and this would be a worst case where if, let's just say, things go horribly wrong for gold and it starts to have a bigger correction, there is one area that I would be, and I myself will buy more physical. I'll buy it as a longer term play. If we ever retrace to the former all-time high from April, look at that base point right here. Look at all these high pivots. Now, again, people won't want to hear this, but it's my job as a technician to always look at the worst case scenario, just like the best case scenario. And that would be the worst case back to 3,500, which in all fairness, a pullback on gold, we've seen them before. It would be approximately from current levels, about a 22% correction, but I would be buying like crazy if it ever gets there. What a move in gold. I mean, incredible. I think it's over from the April lows. So 8 months ago, over 150% gain on silver, blowing everything else out of the water. The only thing I'm watching here is just in the last day or so, we've now hit this level. And look at this trend line. I think what we have to understand is silver is a very momentum driven asset, right? When things are bad, things are bad. And when we see like the 2011 run, it was just epic to the upside. And one more thing I'll show you on this chart. And this is you're right about all these other factors, right? They're very bullish, although those narratives can switch very quickly. But if we look at the move here that we saw in 2011, it was about 500%. And we are now at that same approximate extension move from the April, or I should say from the March 2020 lows. We're at about 515%. And so what we know about silver is that, again, they call it the poor man's gold. People rush into it for the momentum trade. And while I love every point you made on a macro longer term scale, and it has me bullish for silver over the next 5 years, in the near term, I do think that we are now overdone on silver, and silver needs a flush out of the weak hands that have been jumping on this like a meme stock. You and I both know that the meme stock crowd that's just buying it because they think they can dump it for another 50% upside, those are the ones that have to be washed out, clean house, and then silver can get back to fundamentals of grinding higher at a slower pace that will be much, much healthier. But it's not healthy to see silver go this much vertical, and that'll catch people off guard when it corrects massively.
Gold has remained firmly in the headlines as prices continue to trade near record territory, supported by steady central bank accumulation, persistent geopolitical uncertainty, and growing investor demand for hard assets. Recent market activity shows that even during short-term pullbacks, buyers quickly step in, signaling strong underlying confidence. Large institutions and sovereign buyers appear less focused on day-to-day volatility and more on gold's role as protection against currency erosion, rising debt levels, and long-term financial instability. This backdrop has reinforced the view that gold is no longer just reacting to inflation cycles, but is being repriced as a strategic asset in a changing global monetary order. Against this backdrop, Gareth Soloway believes a move toward $5,000 gold is realistic rather than sensational. His view is built on both technical structure and macro pressure, arguing that gold has already broken free from multi-year consolidation ranges and entered a new secular phase. Soloway emphasizes that such a target would not require panic or crisis, but simply a continuation of existing trends, expanding government liabilities, and declining confidence in fiat systems. In his assessment, gold at $5,000 would represent a systemic repricing of value, reflecting long-term monetary stress rather than speculative excess.
I would just throw this out at you is like all these bullish scenarios, what we're basically doing is we're pricing it to perfection, meaning saying, okay, well, assuming the AI build out of hyperscalers and data centers goes everything according to plan. But one of the things we know is that a lot of these proposed $100 billion investments, there's no money there. They have to raise this capital. We've seen what's happened to Oracle when they raised $100 billion in debt. The stock dropped 50% from those highs. And we also know that these data centers, there's literally no energy to power them. And so we've seen data centers being put on hold because of that. So I do wonder if we're pricing in this scenario where everything goes perfectly so silver can continue to go up. But if there's one hiccup, does then silver have that correction and the dreams are essentially dashed? So I think the top call for me was Bitcoin. Bitcoin topping out at around 127,000. It was a great run in Bitcoin. There were lots of calls for 250,000 by year end, but the chart just did not give us that indicator, right? It was telling us that it was at the top. And in fact, I can briefly show on my chart how I was able to make this call very simply by following a key trend line. So let's take a look here. And if we look at Bitcoin and we go to our monthly chart, what we can see here is that in December 2017, we had our peak, our bull market peak. And then here you have your first high in 2021. And all you're doing here is connecting a trend line between those 2 points. And notice no other time does Bitcoin tag that line until we got to October and September of this year. And we had a 1 hit, 2 hits, and 3 hits. And then Bitcoin came down. And really, the key to technical analysis is not overthinking it, right? There doesn't need to be a lot of indicators here. You just simply have a trend line that has told you price could not get through any time in the past, really 5, 6, 7, 8 years. And therefore, we have to assume it's going to stop price here. And so simply put, that was one of the calls that I made this year, and it was a good one. We've seen Bitcoin really pull back substantially. Number one, the Fed, when they lower rates, they only control the short end of the curve, right? They only control the very near-term treasury market. The 10-year, the 20-year, and the 30-year are controlled by the market forces. So again, if you're trying to sell $1 trillion in U.S. debt and there's no buyers, the U.S. must let that interest rate go up until they can convince people to say, okay, I will lend the U.S. $1 trillion, and they're paying me enough interest to make it worth the risk. And we're already seeing that going on in Japan with rates going up there as well with their massive debt to GDP. And if that happens here, it's not going to matter that the Fed is lowering rates. The long end is what's going to be important, and the market will get very spooked because of that. So the yen carry trade, just to summarize that, it's where essentially investors would borrow money at near zero interest rates from Japan, and then they would put it in the US for a much higher return. So it's basically risk-free, right? You're borrowing from this side and you're getting a better return over here on your money. You only pay a tiny amount of interest to Japan, but you're making, let's say, 3-4% in the US. So it's one of those almost like free money type scenarios. But as Japan's rates are going up, that no longer is in play. And so what had happened over the last many, many years, 10, 20 years, the yen carry trade had trillions of dollars being borrowed from Japan and being invested in the US. If interest rates rise there, that trade is going to unwind, sucking trillions of dollars out of the US back to Japan because the rates are higher there now, and it's not as lucrative to borrow money from Japan. He makes a lot of sense, but I would also argue that we kind of have a range already. For instance, we're already seeing the Fed lowering rates back towards their normal, let's say, rate range based on inflation that is still north of 2%, right? So again, the Fed is already saying, all right, let's bring these interest rates down, and it's okay that inflation is above because we expect it to slowly come back in. And so I kind of think that the Fed already does that, even though they have that target of 2%. And my worry, again, is what you just mentioned, which is, again, this is a slippery slope. You start to say, okay, our range is 2% to 3%. All right, well, now it's been, let's say it's 3% for 5 straight years, but you're like, oh, but it's in the range. And then it's 3.1. Oh, well, the range could be, it's just one of those things where, you see the goalposts starting to be moved. And you really have to feel for Americans that, if you're not someone who's invested heavily in the stock market, you're probably struggling. And we know there's a huge percentage of the population that is already really hurting because of where inflation has been. And now you're starting to talk about, well, it's okay if it's a little bit above 2%. We're going to deal with that, and that's acceptable. I think that's a bigger issue. And I would just warn that the Trump administration going into the midterms, they need to really clarify this for the regular folks in the United States, to not say that they're going to accept inflation at 3% now versus 2%, because it will bite them. I do worry about that. Well, I think again, we've looked at history, right? We've seen when interest rates go up, the market tends to revert and get panicky about it because again, it's telling you number one, when we have, I think now we're at 1.2 trillion in interest that we're paying a year on the US debt. I mean, this is all debt that's needing to be refinanced. I think there's something like 7 trillion in debt that needs to be refinanced just over the next year or so. And so these interest payments really do have a major impact, whether it's 4%, 4.5%, you could be talking about hundreds of billions of dollars in additional money that has to go. And it bleeds the US and the American people dry when our tax dollars are essentially being used to pay off the interest on this debt. And so you look at that, then you also look at the valuations in stocks and you say, well, if I can get 4.5 or 5% basically guaranteed, is that better? And so people remove money from the stock market and put it in the bond market. And that again can be another trigger. So there's just a lot of scenarios here where higher yields on the long end will spook investors. And I think the biggest one of all is the loss of confidence in the US financial system, which then brings us back to the de-dollarization that has already started and likely will continue for the next decade. Partially that would be the case is that, well, where else are you going to put your money? I would just say this is the kind of the black swan event is not only what we're talking about with the 10-year, the 20-year, and the 30-year and long end of the yield curve going up, but also the potential that we could see an economic slowdown. And so when you look at the GDP, it looks amazing on the outskirts. The 4.3% growth is absolutely remarkable. But when you think about it, it's so tied to the AI trade and the CapEx from all of these AI companies, 100 billion this way, 100 billion that way, 500 billion this way, from OpenAI to NVIDIA to AMD. But the key here is if you take that away, you're essentially on the borderline of a recession in the US. And so sure, the Fed can cut rates, but if you look historically, if the Fed cuts rates because the economy is weakening into a recession, then actually the stock market sells off on the back of that as well. And so you have these concurrent kind of factors that are going to be battling. But again, if they happen together, like I think, and I do think we will see a continued slowdown in the labor market in 2026.
Looking forward, silver moving toward the $100 level would likely be the result of pressure building quietly and then releasing all at once. Industrial consumption continues to rise as energy systems, advanced electronics, and infrastructure projects demand more silver than the market can comfortably supply. Unlike past cycles, much of this demand is structural rather than discretionary, meaning it does not disappear easily during slowdowns. As available inventories tighten and above-ground stockpiles shrink, even a modest surge in investment demand could create outsized price reactions. In that environment, silver's tendency to move sharply becomes an advantage, allowing price to leap higher in a relatively short window once confidence returns. Gold advancing toward $5,000 reflects a broader monetary shift rather than a rush for quick profits. Persistent debt expansion, weakening purchasing power, and limited policy flexibility have pushed investors to rethink what constitutes real security. Gold benefits from this reassessment because it carries no promise, no yield dependency, and no counterparty risk. As more capital prioritizes preservation over growth, gold's valuation adjusts upward to reflect its role as a financial anchor. A move to $5,000 would signal that markets are no longer treating gold as a hedge on the sidelines, but as a core reference point in an increasingly uncertain global system. Could this unfolding scenario mark the beginning of a new era for silver, where it finally asserts its full value against gold? Share your thoughts in the comment section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.